The private markets are experiencing one of the most dramatic shifts in a while, and for the first time since 2015, more money flowed out of private equity than went in. It's a big issue, and the question really that a lot of people are asking now is, has the private market been tapped from institutional investors?
Taxing people more is not a good thing. I think we're all taxed too much, in my opinion, and I think the biggest problem is government waste, but neither side of the aisle has shown that they want to actually cut spending.
A huge addition that was made permanent and part of the new One Big Beautiful Bill is a 100% bonus depreciation for any asset placed into service after January 19th, 2025.
So this could be an enormous tax benefit to anyone who has R&D expenditures right now. The question is, are you trying to get rich or are you trying to stay rich? If you're trying to get rich, your business is your best avenue to get rich.
Okay, Jim, let's get going. Podcast episode 1, Make Rich Real, where $1 million businesses meet billionaire strategies. So I'm excited to carry a disproportionate amount of weight here.
Yeah.
Are you ready to rock and roll?
Yeah, I'm hoping that you'll do a good job so I'll look better.
Well, today I'm excited. We got a good docket. We're going to talk through the One Big Beautiful Bill, OB3, as it's now been coined, past July 4th. We're going to deep dive into some of the new changes there. We're then going to talk about some changes happening in the private market space, something that you and I are very interested in and invest a lot in. And then we're going to wrap up talking about AI, because who can do a podcast in 2025 and not talk about AI?
Everyone has to talk about AI. There's no pain without AI, but there's no gain without AI.
Okay, there we go. The first dad joke of the day. It didn't take us long. So let's talk through the business tax revolution here that OB3 kicked off for us. July 4th wasn't just Independence Day. I was sitting at the lake house in Wisconsin, and I was following Twitter as I remember the bill was just getting passed and then trying to unpack what was going on there. Where were you at July 4th when OB3 was passed?
I don't remember, but I do remember when it was the bill first got proposed in Congress, and they said that they wanted to get it passed on July 4th. And I just remember thinking, there's no way this thing is going to get passed. If you remember bouncing between the Senate and the House and all the different versions, and then they got it done. So I was shocked and surprised and kind of excited. I'm always excited when there's a new tax law because we get to dive in and learn things for our clients.
Yeah, I kind of missed some of the original House provisions, which would have been a lot better for our small business clients, even better for us.
True.
Well, let's start off, look at visual 1 here. I've got a screenshot, Jim, that I'd love your opinion on. Let's just talk about the cost of OB3. $3.4 trillion is the projections here. And as we look through the about $4.5 trillion is the projected cut or cost of the tax cuts. There's also a $325 billion spending increase baked in. $1.4 trillion of net spending cuts, which we'll talk through some of that, which leads us to about a $3.4 trillion net cost. What's your first reaction of the tax bill? Should we have passed this given the deficit, the debt, the situation we're in? What are your thoughts there?
Yeah, I think it's a bigger question than that. And unfortunately, our government has been financially irresponsible for decades and decades. And my hope has been the last, multiple administrations that someone would care about the deficit and actually try to get it under control. I think taxing people more is not a good thing. I think we're all taxed too much, in my opinion. And I think the biggest problem is government waste, but neither side of the aisle has shown that they want to actually cut spending, which is what we have to do. There's no way you can't tax people enough to solve the problem. You've got to cut spending, and no one wants to cut spending.
Yeah, I hear you there. And when I'm looking at the breakdown, further down, we have the itemization of what's driving this deficit impact, and $2.2 trillion of the total kind of net $3.5 or so trillion is really attributed to just making the tax brackets permanent with where they're at. So really not a true tax cut. It's really more of an extension of the Tax Cuts and Jobs Act from 2017, 2018 there. So really it's, that's I know what some of the conservatives were talking about is that's not truly a tax cut. With some of this, it's just an extension of the lower tax brackets.
There's no doubt everyone would have had a significant tax increase at every bracket level if this had changed. So they've locked it in now, the 10, 12, 22, 24, 32, 35, 37 rates. So I think that's good. I know the Republicans are arguing that the increased economic activity will help, take care of some of these increased, deficit problems. I think that's optimistic. I certainly hope that's true. And again, I don't like taxes because I do think there's a lot of government waste. The problem is it's so hard to figure that out. And I remember, when I got married, and Mimi and I have been married for over 30 years. And at the wedding, they interviewed like mom and dad and Mimi's parents and stuff like that. And it was so interesting. My mom said, hug each other, love each other, all these wonderful things. My dad said, being around all these young people like you gives me hope that you'll somehow handle the problem we have with the deficit. That's what my dad said in our wedding video. And so that's
a wise man.
More than 30 years ago, my dad was worried about the deficit. And if he was alive today, he would be shocked at how that's gotten out of control. But yeah, I mean, I don't think increasing taxes is the answer, but I don't see anyone really that motivated in Washington to handle the spending problem.
The right and left love to spend. That's one common. We're going to break that down in a future episode because it's a fascinating subject to me. And Scott Bessent, Ray Dalio, there's a lot of different approaches. So we'll dive into the deficit and how you and I are going to fix the country in a future episode.
We'll fix it. No problem.
Let's talk through though the tax impacts and these tax cuts through the OB3 and what's important to lower middle market business owners. That's who we talk to all day, every day. That's what we are running ourselves. And let's start with the qualified small business stock enhancement. And so just to frame this up, for small businesses that really defined previously to this where it had less than $50 million of assets on the balance sheet, if they were structured as C corporations in some appropriate different industries, and if the C corp stock was held for 5 or more years, at the sale of that company, if it was an equity sale, they could exclude up to $10 million from the sale from their taxes or 10x their basis. So that has been greatly enhanced. Fill the viewers in on what some of the big changes to the QSBS under Section 1202 were and why this matters.
Yeah, it's very exciting. And, I like anything helping small business owners. And just to be clear, this is for stock issued after July 4th of 2025. If you were issued before, you have that 5-year, $10 million limitation. In the new law, the $10 million actually gets increased to $15 million.
Yep.
And instead of having to hold 5 years, as you know, if you hold 3 years, you get 50% of that $15 million. If you hold 4 years, you get 75%. If you hold 5 years, you get 100%. So much higher exclusion amounts in addition to you don't have to hold the stock as long. And so I think we're going to see, I want to know what you think about this, but I think we're going to see, especially startups, with the intent to sell.
Yep.
Like, why wouldn't you try to take advantage of this if you thought you're going to sell in 3 to 5 years?
Yeah, I think you're spot on. And because with that 3 year at the 50% exclusion, if you were otherwise going to pay, let's say 20% capital gain taxes on the back end, you hold for 3 years, you're effectively paying 10%, assuming you're underneath that 7.5 or that $15 million threshold there. 4 years, 75% exclusion. So I'm seeing, and even some conversations with clients early on, is for those businesses, like you said, that are being built intentionally for that liquidity event in mind. What about doing a restructuring? Do it as set up a new C corporation. We can talk through how you can actually do this, and then start the clock on the 3 year, 4 year, 5 years, and then you get the $15 million or 10x the basis, which is the fair market value of the conversion. So there's a lot of entrepreneurs we've got that have cash flowing businesses, and then they've got maybe side businesses or side projects that they're looking to grow to scale and to sell. And if you're doing that, you really need to dive into that 1202.
For sure. And another thing that a lot of entrepreneurs don't know is you could actually gift shares of stock to, let's say, your kids.
Yeah.
And you could multiply that exemption. So if you had 3 kids, you could get an exemption for each one of those kids, 15 million for each kid, 15 million for you. And you can multiply the benefit of these exclusions and make it just a huge thing at your exit.
Yeah. I was just listening to a case study, and I think there was like Roblox or something like that. Some publicly traded company just went IPO'd. It was 1202. And I think when the founder, I think, did 12 different trusts is what I heard. And so I think there was like over $120 million tax-free by stacking.
Yeah. I love the stacking strategy.
Well, let's put some numbers to this, and let's use an example. So just putting this into context, if you're an S corporation or if you're a partnership, you're a pass-through entity, this does not apply to you. And so as we're talking about that, your federal tax bracket, if you're at the highest tax bracket, it's 37%. In a C corporation, you're going to pay the 21% flat tax, but when you pull money out as a dividend, you're going to pay another, practically speaking, 23.8%. So you're around 44.8 versus just 37%. So that's why you hear about double taxation. But so that's the downside of the C corporations.
Yeah.
But if your business is not distributing a lot of cash flow to you, it could make sense to make the C corp transition anyhow, because it's really a tax drag. And so if you're pumping all of that profit back into your business, I'd rather pay 21% instead of 37%.
Yeah.
So if that's the fact pattern, you're not really getting hit from the double taxation. It actually reduces your tax drag and you could start the clock for the 1202. I think if you're checking those boxes, that's where maybe making a conversion to a C Corp should start piquing your interest and starting getting yourself set up for this.
Yeah, and I've noticed also sometimes with entrepreneurs that have built up a big balance sheet,
Yeah.
or they already had an exit of some kind, their next venture is just to sell the thing, and
Yeah.
they don't need the cash flow. And that,
Yep.
that makes a lot of sense to build it to sell it rather than build it to cash flow your lifestyle or your investments.
Yeah. Well, let's use an example. So if you're a $65 million, let's assume you're doing $65 million revenue, you're a technology company. And again, in the new law, you have to make sure that your asset threshold is less than $75 million. So you can't have more than $75 million of assets on your balance sheet. But if this was an S corporation, $65 million revenue S corporation, they could do an F reorganization to convert to a C corporation. As long as it's after that July 4th date, you would have to really, when you're doing the F reorganization, the fair market value of your stock is your new basis in that C corporation. So when we talk about $15 million or 10x the basis, generally, if you do this right, and that S corp is, let's say, worth $100 million, well, now you have $100 million times 10. You could have technically $1 billion exemption if you sell that business and you held it for the full 5-year cycle. So it really could become a massive strategy. Make sure you do this the right way, but F reorganization from a partnership or S corporation to a C corporation and start that 3 to 5 year clock.
Yeah, I hope we didn't just put anyone to sleep with that, but that's so good. If you listen to, I was on a panel years ago, and I remember I mentioned this 1202, and a couple years after at the same event, they had a panel of these business owners that were exiting that I knew, and one of the guys said, "Hey, I heard an idea from Jim Do 2 years ago, went home, shared it with my team, all my attorneys, everything else. We redid everything. They converted to, they did a F Reorg to a C Corp.
Yeah.
And he said, we're going to have an exit of over $200 million and pay almost no taxes." So I love the shout out. I would have appreciated, he could have bought me lunch or something, but at least I got a shout out for it. But yeah, these things can work. And a lot of entrepreneurs, he was running a big business, didn't even know that existed.
Yeah. Awesome. All right. Well, QSBS gives us the exit strategy. Let's talk about the next provision, which funds the growth to get there. And this is Section 174A. Really, this is the IRS, really, I should say Congress, fixing the research and development issues that were created when they redid the tax code back in 2017. So fill everybody in here on the changes to the research and development expenditures under Section 174.
Yeah, the first thing I'll say is just if you're listening, you're not sure of the difference between a credit and a deduction, I'll just clarify that. A deduction, if I get a $100,000 deduction, that means if I'm in a 40% tax bracket, that deduction reduces my income, so it saves me $40,000, 40% of the $100,000 deduction. If I have a $100,000 tax credit, that's dollar for dollar money in my pocket that I don't have to pay to the government. So a tax credit is always better if it's the same amount than a tax deduction. So with R&D, the research and development tax credit, they had changed the law and not fixed it. And both sides of the aisle kind of felt like it should have been fixed. But they said that if you have these qualified research expenditures to get the tax credit, then you can't, if you use those, you can't then deduct those the same year you're using it for the tax credit. You have to amortize those over 5 years. That created a big problem, didn't work very well. And so they did fix that in the bill to where now you can use those expenses, write them off as deductions that you would normally write off, and then also use them to generate a tax credit.
Yeah, it's crazy. If you think about you're running, let's say, a tech company, you're paying $5 million to your engineers that are doing research and development activities. Instead of taking a $5 million write-off on your tax return, you took roughly $1 million write-off. I paid my engineers $5 million in cash, yet I can only write off $1 million. Yeah. And so this was really punitive to anyone. And the whole idea of this section of the code is to encourage research and development domestically in the United States. Yet, if you did research and development in the United States, you had to write off that expense over 5 years. It made no sense. So now the IRS, or let's just say Congress, they fixed this with the amendments through the One Big Beautiful Bill. Walk us through and walk everyone through here what the new changes are and why this is important.
Yeah, well, now you can actually expense what you're using to qualify for the research and development tax credit. And if your company is doing less than $31 million of gross receipts, or call that gross revenue, then you can amend past tax returns. You can amend 22, 23, and 24. So this could be an enormous tax benefit to anyone who has R&D expenditures right now. If you're doing more than that, you can still accelerate what you have been not expensing either this year or next year. So those are kind of the big things. Anything you wanted to add to that?
No, I think you're spot on. And practically speaking, what we're seeing is that a lot of the entrepreneurs, even if less than $31 million of revenue, are choosing to take a catch-up deduction in 2025. And that's just because the window is sunsetting here on 2022 and to amend the return, and regs still haven't really been published on how to do this. And so practically speaking, for all of these clients who weren't able to write off that full research and development expenditures over the last 3 years, you can catch all of those up in 2025. So then that means you're going to probably be able to like really artificially push down your tax bracket or your taxable income in 2025.
Yeah,
So,
I don't know if you have any thought about, because I think a lot of times entrepreneurs think research and development, I'm not a drug company, I'm not like doing that type of business, so why would it apply to me? Because don't you think that there are a lot of entrepreneurs that R&D tax credit actually applies to them, but they just don't think it does?
Yeah, 100%. I mean, there's a 4-part test that you have to go through. And we've seen entrepreneurs, I mean, anyone who's in like really the health and wellness space and creating any type of proprietary product in that type of space, of course, software qualifies. Even, internal process improvement can also qualify if there's some specific kind of cases there. So yeah, I totally agree.
I've even seen where someone will take an off-the-shelf software program and customize it to the level where it actually qualifies for research and development.
Yep. There's a lot of opportunity here. So that's fixing the expense side. So instead of writing off these expenses, these domestic expenses over 5 years or the foreign expenses over 15 years, now they've also kind of incorporated this with the research and development tax credit. And so again, going back to the Congress, they wanted to incentivize domestic research and development. So now we can write all of the expenses off and then we can make ourselves whole. But now you can also layer in tax credit on top of the deduction. So talk through that and why that's so important, because this is why, I think to your point, if you're an entrepreneur, you actually want to go find qualifying research expenditures or QREs, because not only can you write those off for tax purposes, you can also get a credit for those activities too. So get a full deduction plus a dollar for dollar credit up to a certain amount.
Yeah, and the key is getting that credit. So being able to expense those expenses as you would like to, but also getting a credit for those expenses, that's where you're getting like double bang for the buck.
Yeah.
And that depends on a lot of factors, but typically I would say, what would you say for a range? Maybe 7 to 10% would be a good range federally of your QREs that you would get a credit on?
I think that's where it nets out, especially after you pay the experts who actually do the analysis and do all the substantiation for you, because the credit is technically 20% of the growth of the benchmark, but really you kind of can divide that by 2 because you have to go above hurdles. So I think you're right. As a rule of thumb, maybe 10% of your qualified research expenditures. So using the same example, if you have $5 million of W-2 getting paid to your engineering staff times 10%, that could be a $500,000 credit.
Yeah.
Dollar for dollar tax credit. Hey, I owe $1 million of taxes. Now I owe $500,000 of taxes. That could be a massive swing.
Yeah, I know. I would love a credit, like you go to a restaurant and they have a credit for you.
Yeah.
But can you imagine against your taxes?
You need to set one of those up for me. The clubhouse.
Yeah, right.
Put it on the tab.
Hey, one other thing though, your state can help you too.
Yeah.
Because some states have really beneficial R&D tax credit, and that can help you depending on your state and how much you're paying in state taxes. So don't also remember to look at that with your accountant or whoever's helping you with this.
And in startups as well, if you can't use it to offset federal income taxes, you can use it to offset your self-employment taxes or payroll taxes. And so it's actually really big in the startup space. Or if you have an unprofitable company, you can still use it to offset payroll taxes.
That's a good point, because a lot of people in the startup phase, they're like, well, I have I'm not making any money, I'm not paying any taxes. Why would I care about something called the R&D tax credit?
Yep.
But you made a good point that there are advantages to startups when it comes to R&D.
Yeah. All right. Well, R&D is funding the growth. Qualified small business stock is playing the exits. Let's talk about equipment. We need equipment to scale. A huge addition that was made permanent in part of the new One Big Beautiful Bill is 100% bonus depreciation for any asset placed into service after January 19th, 2025. Previously, it was 40%. So we were at 100% from the Tax Cuts and Jobs Act. We were getting stair-stepped down by 20% per year. 2025 was going to be a 40% bonus depreciation. Now it's 100% bonus depreciation. Why is that so important for all of our entrepreneurs?
Oh my gosh. Well, for multiple reasons. Real estate is the most obvious. The 100% bonus depreciation is going to help folks that are into real estate a lot, but also anything you're buying for your business, equipment and the like. Because the limit previously was $1 million, now it jumped up to $2.5 million, and the phase out used to start at $2.5 million, now it starts at $4 million. So that means above $4 million, those kinds of purchases, you start reducing the amount of your that you were able to use for 179. So it's pretty cool that that has been increased, and there's a lot of different applications as far as this is concerned. You know, vehicles over 6,000 pounds.
Yep.
And as I said, 100% bonus depreciation impacts real estate, but especially the qualified real estate professional. So I don't know if we want to side into that or keep moving on with this.
Yeah, let's talk through it. You teased everyone on the qualified real estate professional status, so go ahead, take that away.
The magic part of that in the tax code, as you know, is that if you're a qualified real estate professional, then you can take passive losses from things like depreciation and actually offset active income. Mm-hmm. That's a pretty powerful thing, because often I know you and I meet entrepreneurs that are like, oh, I want to do a bunch of real estate, cost segs, all this stuff, create all this depreciation and wipe out my taxes. You go, that's great, except you're not a qualified real estate professional. So you have passive losses and you have active income, and those two don't offset. That's a tough lesson that a lot of entrepreneurs have to learn. But if you're a qualified real estate professional, you can take passive losses through things like depreciation, offset active income, and that's magical. And maybe you want to just spend a minute talking about qualified real estate professional, some of the basics about how you become one.
Yeah, so you have to go over 750 hours and more time in real estate than in a qualified real estate trader business than anything else. So you can't be a teacher for 2,000 hours a year and then do real estate for 750 hours. You got to do real estate more than anything else and minimum of 750 hours. And I think the real magic comes into your point is you do real estate. If you hit that qualified real estate professional status, you then do what's called the cost segregation study. And then what they do is an engineer comes in and carves up that building. And instead of writing it all off over 27 and a half years, if it's a personal residence, or 39 years, if it's commercial, they'll allocate some of it to the HVAC, the flooring, the panels, the equipment that's in there. That is what can get bonus depreciated. And then again, with 100% bonus depreciated, write it off in that full year. So that's really the power of stacking some of these strategies.
Yeah. I don't know. When I was a teacher and a coach, I don't know how I could have had an extra 750 hours anyway, but it would have been more than half of what I was doing. So maybe I should have done that. Maybe I'd be a real estate mogul by now.
You probably would be. I struggled with that word a little bit earlier here. I think data centers is another huge thing, right, where there's huge benefits in the bonus depreciation and being able to write off those server racks, the Blackwells, and all of the NVIDIA chips. And that goes into section 168N. And this is, I think, the biggest, newest addition to the tax code from the OB3. And this is really to drive domestic manufacturing and a massive incentive. And it kind of ties in some of the things we've talked about. But what the new 168N, and it's called the qualified production property, it's essentially saying that if you build a domestic manufacturing facility, and there's some rules around that, instead of writing it off over 39 years, you can write it all off today, which is crazy. So you write it off once you place it into service. And again, normally you're writing that off over 39 years. So you're only writing off around 2.5% per year. And the whole goal here is to really push domestic manufacturing. And this is part of, Trump really trying to onshore a lot of jobs and a lot of industry. And so we'll see. He's using the tax code to incentivize it. Will it work? I guess we'll find out over the next several years. What are your takeaways here on
this?
It's
a huge opportunity for anyone that wants to build something in the U.S. to do domestic production or manufacturing. You can imagine the advantage that you have if you can write off that expense day one. It's a huge advantage cost-wise over someone who might be competing with you overseas. Obviously, you're going to have higher cost of labor and stuff like that, but it's going to be a huge advantage. One thing that I thought was interesting in this part of the bill is you can't have parts. There's certain parts of the building you can't expense. So, for example, if you have 80% of the building is production and 20% is offices, you can't write off the offices.
Right.
Stuff like that you need to be aware of, but it's still an enormous opportunity. And I think anyone who's in the space of development like this, I think you should look at this.
Yeah. I mean, and now you stack that bonus depreciation of equipment. So when you're building this building out, if you're doing that qualified production property, right, you can now write off that. Plus, then you got to go fill the factory floor with equipment. Well, now you can write off all of that 100%. And then even for the pieces that maybe is the office space, the parking lot, the whatever else is not qualifying, you then do that cost segregation study. And that's where you just start really stacking these strategies. And it's really, again, going to be massive amounts of capital, I believe, flowing into this space because you can leverage and you can take loans from the bank. And so if we did like an example of you take a loan from the bank and you get a 75% or 70% loan to value, you build a $10 million building. Well, if you get a $10 million deduction, that's worth $3.7 million of tax deductions there at 37%. But if you're only putting 30% cash down on $10 million, that's $3 million. So if I'm $3 million cash down, but I saved $3.7 million in taxes in year one, it's just all upside from there. So granted, I have to operate this building. I got to make sure I'm making money in the operations, but by using leverage, that's where you can be, you can pencil these day one potentially.
Because you have to operate it for a while, right? Don't you have to operate it for 10 years?
Yeah, there is a 10-year recapture. So that is a big piece that, they want to make sure that you're not just building these buildings and then shutting them down and writing them off. So there is a recapture that if you do not, essentially if the change in use triggers that and you recapture it all ordinary income. So yeah, you're going to pay all the taxes back if you don't, put it in use for 10 years there.
Yeah, makes sense.
All right, well, let's talk through, I think this is your favorite section of the tax code, Jim. Section 199, Cap A, qualified business income. Not a whole lot of changes, but maybe explain why this was a massive change when this was introduced with the Tax Cuts and Jobs Act, when Trump's original bill, what it is, why entrepreneurs need to care about this, and then maybe just high level, what were a few of the small tweaks that were made here.
Yeah, so qualified business income deduction. That was brought in, as you said, in 2017, Tax Cuts and Jobs Act, because they cut the corporate rate, the C Corp rate, to 21%.
Yep.
So to be fair to the business owners that have flow-through entities, think LLCs, S Corps, partnerships, sole proprietorships, those are all flow-through entities, meaning the income all flows through to the owner, and that's where it's taxed. So to be fair to the owners, they created this 20% deduction. But just like everything the government does, they didn't make it simple. And so there's a lot that goes into this calculation, but it's something that often gets overlooked, and planning opportunities get overlooked by CPAs when it comes to this QBI deduction. And then there's phase outs. So if you make too much money, then you phase out. For 2025, single taxpayers from $197,300 to $247,300, married filing jointly $394,600 to $494,600. They're increasing those limits so that more people will qualify starting in 2026. So they're adding $25,000 to the phase out for the single and $150,000 for the married filing jointly. So if we were using those numbers I just gave, the top end of the phase out for single would be about $272,000, and the phase out for the married filing jointly would be about $544,000 if I'm doing the math right on that. And then beyond that, it becomes a W-2 wage or a W-2 wage and unadjusted basis in property for the business test, unless you're an SSTB. You see how complicated this gets.
Yeah, you lost me, but yes. And you lost SSTB. Everybody.
Yeah, that's all right. Anyway, the point is, line 13, if you want to look at your tax return, a lot of entrepreneurs don't want to look at their tax return, but if you look at your 1040, line 13, it will tell you your qualified business income deduction. If that number is zero and you want to flow through entity, you want to go to your accountant and go, why is this number zero? And there might be a good reason behind it. But then the next question is there a way we can make this number not be zero? Mm-hmm. And I think that's the key for an entrepreneur, is know where to look on the tax return so you can very quickly figure out if you're getting this deduction or not.
I think when you and Mimi go on date night, if she just says 199 Cap A, I think your energy just increases.
That would make me pretty amorous if she started talking to me. I'd be like, honey, using tax codes, that's like talking dirty to me, But I'm sure Mimi would not want us talking about 199A on a date night.
I bet you're right. All right, that's it with what we're going to talk about with OB3. We're going to pick up some of the changes that happen on the personal return in our next episode. But let's talk through some things that are happening in the private markets. There's a lot of interesting things going on right now, and I put some data together here, but the private markets are experiencing one of the most dramatic shifts in a while. And for the first time since 2015, more money flowed out of private equity than went in. And so it's interesting to see that there's been huge tailwinds of a lot of investors moving money into private markets. And I think that's going to continue, and we'll talk about that. But what's interesting here is there's something called DPI, which is distributions to paid in capital. Think of that, of every $1 I put into private markets, how much money am I getting out? So it's kind of like a cash on cash return for your investments. Now, 2.5 times more LPs rank DPI, which again, distributions to paid in capital, as the most critical variable when vetting private markets. And this is because there's been a bunch of money going into private markets and not a whole lot of money going out. And we're going to talk through that. What is your gut reaction when you hear something like this?
It tells me the market's growing dramatically, because I think private equity used to be many years ago, when I started in the business, that was like family offices and billionaires would invest in private equity. You and I wouldn't invest in private equity, or I should say normal people, because we're not billionaires yet. How about that? I'll say we're not billionaires yet. But it was a thing where, billionaire families would invest in private equity. And for a billionaire family, they don't worry about liquidity. They don't worry about getting their money back right away. They worry about long-term growth. And so things like dividends and payouts didn't matter that much. Now, as the market's growing, you have a lot of people. I know you and I are both invested in private equity. Mm-hmm. You have a lot more people invested in private equity. And guess what? More people care about getting their money back and getting dividends and getting payouts than the way it used to be done. So I think part of it is a shift where a lot more people are aware of it and people are investing in it who have different objectives than maybe the families and the billionaires that used to invest primarily 30 years ago.
Yeah, I agree. And we've got a chart here. So chart up, we see the median private equity company hold times. And you can see it's kind of a gradual up and to the right, which just means that the private equity companies are coming in and buying small businesses. And instead of flipping them kind of really every 3 to 4 years, which is what they were doing before, it's now moved to 6 years, 7 years, and even 8 years at the current pace. And so that just means that the private equity company is owning these businesses for longer. But as they're sitting on these businesses, they're funded by all these investors. And so all these investors, all their money's just stuck in that fund, and they need the private equity company to sell out of those underlying businesses so they can return the money back to investors. So it's a big issue. And the question really that a lot of people are asking now is this really just because has the private market been tapped from institutional investors? So when you're thinking of the endowments, the CalPERS, the Yale Endowment, when you're thinking of all these big financial institutions, have they essentially maxed out their allocation to private equity? And so therefore there's not a whole lot of new buyers coming in, and since this is the theory, not a whole lot of new buyers coming in, there's no liquidity on the back end for private equity. And so we'll talk through how I think they're really trying to get into retail, because that could be a new release valve for them. But do you think that's what's happening right now?
That's part of it. I also think, too, things go in cycles, and you have the hot investments that people are excited about. And private equity had so many incredible returns for so many years, and now we've had a little pause. Like they haven't been doing as well in the last couple of years as they have for a long time.
Yeah.
So I think part of it might just be a natural pendulum swing where some investors were over-allocated to private equity, or the returns haven't been as good as of late, so that now they're spreading the money in other places. So that always one thing too, when people rebalance, when the wealthiest investors and institutional investors rebalance, they've been rebalancing away from private equity. I think that's part of it too.
Yeah. Yep. All right. Well, next chart, we got a chart up here, investments and exits in the private space. This is from Bain. And really the top right there, funds raised, you can see it actually was down 23% 2023 to 2024 from $523 billion to $401 billion. I think this is a blip. I think that the private markets are going to continue to raise a lot of capital. 2024 was a great year in the stock market, so private markets were competing against the Nasdaq and the S&P 500. If you look back at 22 and some of these years where the market didn't do so well, private markets tend to zig when the public markets zag. So my personal belief here is that there's going to continue to be a lot more money flowing into private markets, and this is just a blip.
Yeah, I'd agree with that. I don't have anything to add.
Awesome. All right. Well, one thing that could accelerate the injection of capital is President Trump signed an executive order, and he's really demanding the Department of Labor and the SEC to provide implementation guidelines on how ERISA plans, which are 401ks, can start investing in these private markets. And right now, the big issue is from the SEC's perspective, there's a 15% cap on illiquid holdings that mutual funds can have. And also a lot of the plan sponsors. So if you're a company, and we're a company, we've got a 401k. Yep. We don't want to get sued by our employees. And how do you get sued by your employees is if you put really expensive funds in the 401k, you're not acting as a 338 fiduciary, they can sue you. And there's a lot of lawsuits going on. Intel notably was subject of a huge class action lawsuit there. And so there's a lot of that's why there hasn't been a whole lot of private markets in these 401ks, because it's generally a higher cost investment vehicle, illiquidity. There's all these different issues, and President Trump essentially signed an executive order trying to eliminate or reduce those barriers.
And just to be clear, did you start the class action lawsuit against Intel?
I did not.
Okay, because I know you worked for Intel.
I did not participate. And
Many years ago.
back when I worked there, we were actually Fortune 50, or they were, and now they're just a relic of the past.
Yeah, well, once you left, I think that was the beginning of the end for Intel. A lot of people don't know that. That's a little secret that when Bryce Keffler left, that was the end of Intel. It's interesting. I think that it's overblown with some of the media stuff with this thing with 401ks because just like you mentioned, 401k providers and business owners, there's people who have fiduciary responsibilities for the employees. And I don't know anyone who has fiduciary responsibility who would want, someone who's putting $1,000 a month into their 401k, who's uneducated about investments, to be having some of their money go into private equity. So I think it's going to be a slow move, and they're going to have to get people in the 401k markets, like some of the big providers, as well as some understanding about ERISA laws and how those apply, because ERISA laws are like the IRS. They're very powerful. Yeah. So I think there's going to be reluctance to make that available for people who have 401ks. But I do think in the retail expansion, people are they're learning more and more about this. We talk a lot about this with our clients, that we didn't talk about this stuff 15 years ago, that we're talking about this all the time. My good friend Bob Fraser just came out with a book, Invest Like a Billionaire. He talks about it in there. Tony Robbins came out with a book, The Holy Grail of Investing, I think was the name of it.
Great book,
where he talked about private equity and all these different, private credit and venture capital and the stuff that really only the wealthiest people in the largest institutions invested in. And now this is becoming common knowledge. I think a bigger opening of the floodgate would be if they somehow relax some of the accredited investor rules. Because that's been talked about a little bit too. Yeah. And the argument is, why should someone, just because they're not making, $200,000 a year for 2 out of the last 3 years or something like that? Yeah. And $1 million net worth, not including your home, whatever the numbers are, those eliminate a lot of people from being able to invest in private equity, no matter how smart they are, no matter how savvy they are. And is that fair? So there's been some talk. If they relax the accredited investor rules, then I think you would see massive inflows to private equity, because you've got a lot of people who've only had access to public markets. And just the way we've seen money move to crypto when that became available. And by the way, I think crypto doesn't have any limitations with who can invest in it. So why should private equity be so rigid about who can invest in it? Now, obviously, I think people got to be smart and not be dumb. And the money has lockup periods and all these kinds of things. But I think people should be able to invest in things more than just public equities and public bonds.
Yeah, the education is going to be the difficult piece. And how do you educate if you reduce those barriers for the accredited investors? The theory being, hey, you're sophisticated because you make a lot of money or you have a balance sheet, therefore you know what's going on. But it also leads to, well, how can I become wealthy or sophisticated if I don't have access? So it's a catch-22.
And if you think about it, people buying individual stocks, I've known a lot of people who've lost their blank trying to day trade, right? Remember, day trading was this big hot thing, like when the internet was first coming out. And you can day trade and not be an accredited investor, but you can't invest in private equity if you're not an accredited investor. So that, to me, seems right. You can do dumb stuff with your money. There's no, what do they say, that the difference between genius and stupidity is there's a limit to genius.
Okay, that's a new one for me. I like it. Well, why this matters? So the market opportunity, this really would double the TAM. There's about $12.5 trillion in 401k assets. Right now, according to McKinsey, in 2023, the entire private market AUM was $13 trillion. So if you allow these guys to sell through or sell into this channel, it doubles their TAM. And then can we start seeing a reduction in the whole time of private equity, because now there's all this new cash potentially coming in. So it'll be interesting to see the developments here. And I know I just recently, T. Rowe Price is now doing a partnership with Goldman Sachs. T. Rowe Price has distribution into these qualified plans. Goldman Sachs has access to private, deals and markets. So it'll be interesting to see if that's a marriage that potentially is, laying the groundwork for expansion in here.
It's going to be interesting to watch.
Yeah. Well, why would you want to invest in private markets? And really the big reason, and we go to the next chart here, is going to be historical outperformance. So this chart just shows the global private equity net return versus the stock market net return. That's the gold bar there. And really what this shows is over the last, let's call it 30 years, private equity's done 15.6% annualized versus the stock market doing 8% annualized. And so the idea being that you're accepting this illiquidity, you're accepting your money getting tied up for what was 3 or 4 years, now closer to 7 or 8 years, but you're going to outperform. And over the long term, that's held true. But if you look on the left-hand side of that exact same chart, it's really that gap has shrank. Because now if you look over the last 5 years, private markets have done 15% per year, global stock market 13% per year. So only a 2% spread. So curious to see, do you think the private markets are going to continue to outperform the publicly traded markets longer term?
Boy, I wish I was smart enough to know the answer to that question, but I will say that when we just look at fundamentals of finance, which, it's easy to look at trends and people try to guess the future, but usually things come back to fundamentals. Mm-hmm. And fundamentally speaking, private equity should outperform global stocks. And the reason why I say that is private equity there's illiquidity. You can't get your money out right away. Whenever there's an investment that's illiquid, it should perform better than an investment that's liquid, all things being equal. And so there's things about private equity that inherently should make it outperform. It's also the reason why you want to not just have all your money in private equity.
Right.
That's why you want to be diversified. And so stocks and bonds have their place, private equity has its place, venture capital, private credit, all those things have its place as you grow your balance sheet and your wealth. And for entrepreneurs especially, because entrepreneurs are the ones who can get seriously wealthy in this country, having that diverse portfolio, and I know entrepreneurs, and you and I both know, who they're like, I only want to invest in real estate and Bitcoin or something like that. It's like, and they don't feel comfortable with things like traditional stocks. And I say, you should own all of that stuff, right? Because the question is, are you trying to get rich or are you trying to stay rich? If you're trying to get rich, your business is your best avenue to get rich, being concentrated in that investment. But once you have a liquidity event or you peel enough money out of your business to build a balance sheet, then you want to stay rich. And to stay rich, no billionaire has all their money in one thing or one category. They've got it spread around. And every entrepreneur, once they get to a certain level of wealth, they should spread it around too. So a long way to answer your question. Over a long period of time, I think private equity will outperform global stocks, but it doesn't mean that people should ignore global stocks because that should be a part of your portfolio too. And there will be times when global stocks outperform private equity. That's just natural.
Yep. Nope. I agree. And one way that I know that I'm taking advantage of this investment opportunity, not investment advice, is GP stakes. And so that's the pick and shovel approach to investing in private equity. That my bet, which may be wrong, is that there's going to continue to be more money flowing into private equity, whether it's unlocking all these ERISA 401k plans. There's just more traction there. But what I'm doing is investing in GP stakes, which is the actual general partnership stakes in these private equity companies. They're the ones who charge the 2% per year fee. They get 20% of profits. And so really, if you think that the private market's going to grow and they're going to fundraise more, this is like the pick and shovel approach. So instead of choosing, hey, which private equity company do I think is going to perform really well? Well, GP stakes allows you to just invest a minority interest in a bunch of different.
Yeah, I know we think the same on this, but maybe for the listeners out there, why would a private equity group allow you to invest in GP stakes? Why would they let you share in the management fee and some of the upside that they would normally just keep for general partners? Why would they do that?
Yeah, well, the big reason is they have to generally co-invest with all of their LPs or limited partners in their funds. And so if they're going to raise $100 million, they generally need to co-invest around 5%. So that means they need to come up with $5 million of their own cash to go invest in that fund. Well, if they're rolling out funds every year or 2 years, this can be tens of millions of dollars, if not billions of dollars, that they need to co-invest. Well, they're not necessarily super liquid. So therefore, they can sell some equity or minority equity stakes in their company for cash, take the cash, and then go reinvest it in their own fund. So that's a big reason. But also, just like anybody else, sometimes they want to take chips off the table. Sometimes they need more growth capital. Sometimes they need to facilitate a transition plan internally through different general partners. So there's all those other reasons too. But I think that co-invest piece is a big driver, and that's what's really drumming up and taking driving a lot of demand for the GP stakes.
Yeah, makes sense.
All right, well, let's talk through AI. Let's talk through really I've got a chart here that I think I saw this on Twitter, and it's pretty sweet.
It's got to be true if it was on Twitter.
Yeah, I love Twitter. I'm addicted to
Is Twitter
X.
even around anymore?
It's X, I think, technically.
Yeah.
But
I don't want to age shame you, for an older guy knowing that it's not Twitter anymore, but that's a different story.
If that's where you want to, shame me, I'll take that every day. But I thought this was cool because, and I actually heard JD Vance at an AI conference kind of refer to this number as well. And really the projection in this data shows the infrastructure capital expenditures as a percentage of GDP. And what it's showing is that in railroads in the 1880s was 6% of our GDP. So 6% of everything that was essentially created by the United States there in the late 1880s was building these railroads out across the United States. Telecom, I think was the early 2000s, so it shouldn't be 2020. That's where we know Twitter's wrong. That's the early 2000s.
There you go, X.
1% of 1% of GDP. This was laying the fiber that we didn't really need all that fiber until actually later.
Right.
But then you see AI data centers.
At my age, I need a different kind of fiber, but that's
data centers, 1.2% of GDP is the projection this year. Next year, projected to be 2% of GDP. And I listened to Jensen, the CEO of NVIDIA, talk about this too, and just how many hundreds of billions of dollars of CapEx build out he's forecasting. He sees it better than anyone. NVIDIA, he's got the only game in town. But what the real question here is, how long can this continue with this massive data center build out and this AI race? Data centers, these LLMs and everything that goes with that. And just, this has really been carrying GDP growth here in the last 6 months in the United States.
Yeah, absolutely. And I actually believe that this is going to be driving GDP growth for a while. It's one of these inflection points that, like you said, the railroads, right? That was an inflection point. The personal computer was an inflection point. The internet was an inflection point. This is going to be one of those inflection points where things change dramatically. And actually, this creates an opportunity that maybe because still the United States is the center of AI, and we're also the center of entrepreneurship. And if you look at countries like China who have more resources and more people, what inevitably ends up happening, and I think will continue to happen, is our entrepreneurial spirit in America and our ability to kind of create new companies and everything else ends up leading the way. So my hope is that actually drives GDP, helps us drive the economy so that we can pay down the deficit. So I'll circle all the way back to that before. But I think it's going to continue, and it's going to continue for a while.
Yeah. Well, hey, getting some productivity gains through AI and making us more efficient as citizens, which can hopefully reduce our deficit, would be a great outcome here. And then let's tie this into what we're doing here from the fractional family office floor. What is our approach to AI? And I love the way that it was framed up by our COO, Justin Crawford, and he took this from Ethan Malik, and it's called Leadership, Vision, the Lab Innovation, and Crowd Adoption. And if we throw this as like the last visual that we've got here, the whole idea is that it all starts with leadership. So for our entrepreneurs, this is something we're really encouraging them to build a strategic AI vision and create urgency within their organization around it, because AI is coming. It's like the railroads in the 1880s. It is coming full steam ahead, and no one's going to stop it. And so I think leaders and entrepreneurs need to embrace it, and they need to just start brick by brick. So I think that's the first piece, is just being open and accepting that this is coming. The next is the lab. Lab is really the operational excellence and then the innovation through in-house IP creation. So the lab is, you need to make sure that you're figuring out a way to build this and weave this into your workflows, whether you're going to build your own AI agents, whether you're just going to incorporate this in your workflows to drive efficiencies. But the lab are going to be the actual doers that execute that vision. And then the crowd is the adoption from the employee and the clients. And that's going to help the lab build these specific use cases. And so this is the framework we're taking, of that we're setting the strategic vision of where AI is going in our business. And I just saw a Microsoft report that they listed the top 40 different industries are going to be the most disrupted, and financial planning was number 30. So it is really coming after this industry, and I think there's a lot of disruption to be had in our industry. So I'm excited for that. Yeah. But the lab is then Justin's team. We've got our operations, our data analysts, our scientists there that are going to help implement a lot of the ideas that leadership and then the crowd, our employees and our entrepreneurs want. So what are your thoughts on our approach to AI and where we're going here within our fractional family office?
I'm extremely excited about it. And someone said to me once, and maybe this was even a famous person, or someone who ripped someone off, but someone said to me once that it's not AI that's going to put businesses out of business. It's other businesses in that space that are using AI better.
Yep.
And so I think that's the key. If you're a business owner, which I would guess our listeners are business owners, is that you want to think about having an actual clear vision and plan as a leader of your company, because your employees are going to be wondering. They're going to be wondering, like, what are we doing with this AI thing? And I've seen a lot of entrepreneurs who bring it into their business, but it's so random. They just tell people, get on ChatGPT or get on Claude or get on one of these and just play around and do whatever you want. And number one, they're not actually worried about safety and privacy and IP protection, which you have to worry about in that. But secondly, they're giving no direction to their employees. And so employees might be doing it to create their grocery list, but they may not be using it productively within the company. So I love what you said, leadership and taking charge of what's the vision for the company. And then the lab and the crowd, and those work so well together, which is the crowd, your employees can kind of craft like, what do we need to do? What processes could be streamlined through AI? What advances can we make? What time can we save? And then the lab within your organization is creating those, whether it's the prompts or whatever you do, creating those or AI agents to actually deliver on that. And because of the way the world works today, I know we use a lot of outsourcing, 1099. We have some really brilliant people in the AI space that are not W-2 employees that we contract with to help us build out some of these things.
Yep. Awesome. Well, that's a wrap here for us today. What's your biggest takeaway? All the topics we covered today. What do 7 and 9 figure entrepreneurs need to know?
My biggest takeaway, Bryce Keffler brought down Intel. That would be my biggest takeaway. No, I think the biggest takeaway is when it comes to tax planning, we talked a lot about the OB3. When it comes to tax planning, I see entrepreneurs make the biggest mistake they make. I'll say they make two big mistakes. One, they either are working with a CPA who's a tax historian. They're just filing the forms. They're really not coming with anything proactive, no new ideas, because the magic in tax planning is the uniqueness of each entrepreneur situation. So they're not taking advantage of the tax code to help them pay less taxes. The other extreme is they hire someone you might call a tax strategist. And there's a lot of that out there right now, who is someone who is trying to save them in taxes, but they're overly aggressive and they're getting paid through introductions. They're getting paid sometimes a success fee. Don't ever pay a success fee when you're trying to get your tax planning done. It creates a bad scenario where someone's driving to make you do things that may be too risky to save on taxes. So really think about having a team when it comes to everything in your fractional family office, but especially the tax planning. So you should have a team that's working together to get you the least amount of tax as possible, but also understanding your risk tolerance when it comes to tax and also understanding your situation. Because the magic is not just taking a buddy of yours idea and implementing it as far as tax planning. It's having a plan where you're working with your team in your unique circumstances.
Okay, that is a takeaway.
There was a lot.
My takeaway here is really the AI build-out and OB3 incentivizing from a tax perspective the continued AI build-out. When we talked about the qualified production property that you can now write off those entire manufacturing facilities. I mean, think about if you're manufacturing robots and robotics, you know, we're talking about that and what that looks like through the incorporation of AI and bonus depreciation. And then, you know, already we got AI at 1.2, scaling to 2.5% of GDP. I think that train is just starting, because when you stack in the tax benefits and the tax code, it's very clear that Congress and President Trump are trying to incentivize continued investment in AI and in really domestic manufacturing. So the scale of that is just, and then the downstream effects is massive to all the trades and construction, to electricity demand and energy. So it'll be really interesting to see how these next 12, 18 months unpack there.
Yeah, that was good. I agree. Send a letter to Intel. Apologize.
Will do.
Thanks for listening to Make Rich Real, where $1 million businesses meet billionaire strategies. Please note the following disclosure.
This podcast is provided by Do Wealth Management, an SEC registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performance is for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dowealth.com, or upon request.